You're watching Single Process with Bob and Joe. We created this video series to help you navigate through the very difficult process of divorce. We hope this helps you on your journey. In this episode, we are going to be talking about mortgages.
Get braced. This is way more exciting than you think. I happen, if you are recently divorced, how do you know if you can keep your home or not? This is the big question, right?
Undertaking that financial commitment by yourself is just overwhelming. I had this urge to rent, so I didn't have any overhead and no permanence. But then the interest rate environment really didn't lend itself to that.
I agree.
And then I had to figure out if I could get a mortgage.
You really need someone to break it down for you, which is why I'm glad Terry's going to talk to us, because Terry Hastings is a banker with Total Mortgage Services in Connecticut. But in addition to his mortgage expertise, he actually teaches CE classes to over 1,000 real estate agents every year. And he worked as a real estate broker in his past. So he comes up with all kinds of creative and resourceful solutions that the average person wouldn't have. So Terry,
Welcome,
Thanks.
Terry.
Great to be here.
Start us out. How do you spell mortgage? So really, the first thing that happens typically is someone finds themselves divorced, and they're probably not sure if they can stay in their matrimonial home or not, right?
Yes, correct.
Okay, so what would you tell them?
The first thing I would tell them to do is to run a credit report. Because a credit report, during this tumultuous time you've been going through, it's been an emotional journey, but you've been a financial dust mop going around collecting all kinds of things that you might not even know on your credit report. So I would go to a company like myfico.com and pull your own credit report. Since the consumer's pulling the credit report, it doesn't act against them.
Okay, see, I always heard that. The minute you pull your credit report, it doesn't hurt your credit score.
The moment you pull it. If you go to a banker and I say, let me just pull your credit report, because it's a credit inquiry, and the way the algorithm goes is they think you're going to pull some credit, and you're going to apply for a loan, you might be doing it elsewhere. It's like shaking up a snow globe. The more that you apply for credit, the lower your score will drop.
Okay.
I went and checked my credit score after doing our pre-interview with you, which I hadn't done. And, better late than never,
I'm shocked
right?
she did this.
And I was just surprised I had almost nothing there, but just a short credit history or one bill that went 60 days because I just overlooked it during the divorce process when I was overwhelmed had affected my credit score. Tell us about that.
And it's a very common thing where there's a lot going on in your life, and the last thing you're thinking about is, boy, I have to make sure the cable's paid or something because so much is going on.
That kind of stuff affects your credit score?
It can. Some cable companies might report to the credit bureau, so it's a question of who's reporting to the credit bureau. But in your case, you didn't have much credit because you weren't attached to either credit cards or mortgage, where it's very important for a spouse to find that out and to pull their credit. Conversely, what might happen is that you might be attached to your ex's credit. If your ex misses a payment on one of those cards, your credit scores are going to just totally
That's
plunge.
what's happening to me.
So what do you do if your credit's not good, Terry? What's the fix?
Well, the first thing I'd do is I'd scrub your credit. I'd make sure that the credit accounts on the credit report are actually yours.
Okay.
If they're not yours, I would call the credit company and say, I want to have these taken off. If your credit score is that low, sometimes it's worth hiring a credit counselor who helps you with this and helps scrub your credit. But it's the sort of situation where you didn't get into it in 6 months, you're probably not going to get out of it in 6 months.
Okay, so talk about that timing.
What if it's just because you don't have a lot of credit history? Is there a quick way to fix that?
Sure. If you don't have a lot of credit history, your credit score is probably okay because you don't have lates on it, but they do want to see more credit history. In some cases, it might be a good idea to ask a family member if you could be an authorized user on their credit card. If, for instance,
What do you mean?
Well, let's say you have a family member that loves you. And one of them, it's going to be a tough choice.
Okay, all right.
So what you do is you ask them to make you an authorized user on one of their credit cards.
What? I've never heard of this before.
Good thing I'm here.
I'm well into my 40s, so I'm going to go to my mom and ask her to throw me on her credit report.
Absolutely.
On her credit card. I'll pick a card.
On her credit card. And you
can
could even say, Mom, make me a co-borrower or an authorized user. And what's going to happen the next time the credit report comes out, your name is on there. Mom's history gets dragged over to your credit report. Keep in mind, though, you want to make sure mom's history is okay.
I was going to say, I need to run a FICO on her, too.
So you want to make sure mom's history is okay. You want to make sure that if mom has a $5,000 credit card, that she's using less than 25% as a balance. That'll keep the score up higher.
So you guys can consult on this, or somebody can tell you.
I do that all the time. I get the phone calls from people saying I'm going through a divorce situation, can help me, and I'll look at their credit and I'll counsel them on that. It's part of my job.
Okay, so once that's done, how do I figure out if I can afford to stay in my home or buy a new home? What is the asset to or income to loan ratio that one should be looking at?
General underwriting guidelines are going to allow you to use 43% of your gross monthly income. So let's make it really simple for math's sake. If you make $120,000 a year, that's $10,000 a month.
Okay.
General underwriting guidelines will say you can use $4,300 a month toward your new mortgage, which is principal, interest, taxes, and insurance,
Okay.
and any monthly debts that appear on your credit report. So monthly debt might be a car payment. If you have $1,500 on your credit card, that's not the debt. The debt is what's the minimum payment that you owe. So that whole thing can add up to $4,300 or 43%.
43%. Okay.
So that's what we look at to say what are your expenses and what are your allowable expenses.
Okay.
So is it a good idea while you're still, if you're buying out, let's take the scenario where you're buying out the matrimonial home, is it a good idea to do it during the divorce negotiation process? I mean,
be
once
proactive about
afterwards,
it, yeah.
Will they look at your joint income at that time? How does that work?
Sometimes during the divorce process, things aren't going that smoothly. So
Guaranteed. Even if it's a harmonious.
that's why I get people who call me and say, I'm going through, it's an easy divorce. And I go, okay.
Yeah, no
but
such thing.
What's happening is as soon as you file for divorce, you're party to a lawsuit. And so the Uniform Residential Loan Application has a question there that says, are you currently party to a lawsuit? If you're
I would say
involved in a
no.
lawsuit, the answer is yes.
The answer is
So
yes.
filing for divorce means that you cannot apply for credit. You cannot seek.
Well, you have to disclose.
You have to disclose that you're party to a lawsuit.
Okay.
The only way a bank, for the most part, the only way for a bank to talk to you about a loan is if you have a separation agreement that's approved by the court or you have a divorce decree. So you either have to do it before or after, because from a bank standpoint, it makes total sense. You're in a situation where you're negotiating something. The bank doesn't know how much money you're going to get or how much money you're going to pay.
And what your
So they want to say,
liabilities
let's
are.
let all this
You're trying
settle
to
down.
resolve where you're going to live. So what?
So
would
do
you
people put in their divorce agreements, I get X amount of time to buy you out of the house?
In some cases, what I'll see is that people have a year to purchase out the spouse.
Okay.
Or they have to sell the house.
But now talk to me about the fact that I was getting alimony and I thought, I'll get a mortgage. My alimony will cover my mortgage. And then the bank was like, well, you need alimony for X amount of time and X amount of time going forward. And so I didn't have that period of time.
So what we're
does
looking
that
for is
look
we're
like?
looking for a stream of income
Okay.
that's going to pay for your expenses. Because in the past, we used to have stated income before 2008, and then things went completely out of control, as everybody knows.
Yeah.
You heard of that.
I heard that.
So what they do now is they trust but verify. They're going to verify everything. They want to make sure you have an income stream coming in. As far as alimony, that's an income stream. But what they're going to do is they're going to say, do you have alimony coming for at least 3 more years?
Oh wow.
Give me your divorce decree, and I need to see that you have alimony continually coming in for 3 years. In addition, I want to see that you've had it for the last 6 months.
So you
So
need
wait.
6 months of alimony before you can actually
Okay.
go.
Well, if you walk out of the courthouse,
that's what you're relying on.
Absolutely. You walk out of the courthouse and say, "I'm getting alimony." The bank's going to say, "I need
wanna
to
see
that
6
you're-"
months back,
I need no.
3 months
The day
front.
you walked out of the courthouse, they're going to say, "I need to see 6 months into the future that your ex is paying you."
What if you're not getting alimony? Can you qualify on just assets
Absolutely.
for a mortgage?
So assets is not necessarily just your job. It could be dividend income, it could be trust income, it could be interest income.
Okay.
So there are assets that you have that produce other income.
So now let's assume we're financially set up to get the mortgage. How do I go about it? Do I go to a mortgage broker? Do I go to a lender?
Good
What
question.
What
Yeah.
does that
What's the
look like?
difference?
It's very confusing today. A mortgage broker is a person who knows a guy. He knows a guy who's got some money.
So he's got a phone
So what
call.
happens is they're
Like
going
a
to
middleman.
prepare your file. They're a middleman. They're going to prepare your file, present it to that third party, and that third party is going to say, "Get this paper from Barbara. Get this paper. Get this paper." They'll get it all that cleared out. Then the day of the closing, that person is going to be writing the check for the loan.
But doesn't that allow you then to shop and get the most effective rate?
In some cases.
Okay.
So, for instance, I'm a mortgage banker and I'm a broker, but 90% of
So
my
the
business
mortgage
is
banker
banking.
part means you make the loan yourself.
It's our money.
It's your money.
So we're going to underwrite it, and it's going to be our money. We're going to lend the money out at the table. In most cases, banks will sell that loan off to somebody else afterwards.
Okay.
The federal government is the largest purchasers of mortgages in the United States. So we might be selling it to Fannie Mae or Freddie Mac, which is the federal government. So, but we're going to lend out the money. We're going to make the underwriting decision in-house. It's quicker. We're not relying upon somebody in Oklahoma picking up the phone or grabbing your file. It's just, we're more hands-on, and having done both, I much prefer the banking side of it.
But does a relationship matter in the process? If I know if I have a good relationship with my local bank, is that going to be more advantageous in securing? I know that wouldn't be you, so you're going to say no. But honestly, does that help?
No.
It doesn't.
Because if I make an exception for you and I say, "Now, Barbara's really nice, I'm going to give her the loan." A bank might look at that and say, "Why did you give Barbara a loan, but you didn't give Joe a loan?"
Okay.
Because there might be some discrimination there because we go by fair housing and fair lending as well. So they're going to look and say, "What rate did you give Barbara? What rate did you give Joe?"
Okay, so talk to me about all these online things popping up, online pre-approval letters, online.
Oh, yeah. You get a pre-approval letter in like 10 seconds online.
You can get anything online today. Anything online today.
You can find a guy online.
Should we?
Not yet.
Not yet. I gotta wait.
Don't jump the gun. So you can get a pre-approval online, but it's a question of how good is it. So a pre-approval is subject to, subject to, subject to. So you can go online and you can put in information, but the information that you put in might not necessarily be true.
Okay.
Because you might say, "You know what, I make X per year," but you're self-employed. So you're not using your net income, you're using your gross income.
Yep.
So you get a pre-approval letter that's spit out that says, "Yes, you're pre-approved," but it's subject to verification of all the information that you put in.
Okay.
You're better off talking to somebody, whether it's your local lender, talking to somebody who is a licensed mortgage loan officer, not just a registered loan officer. A licensed mortgage loan officer was required to take testing, they're required to take continuing education every year. They're just, to me, it's a higher standard that they're held to. Sometimes the best rate that you see online, and you say, "Well, can I get a lower rate online?"
Yeah.
You might see a lower rate online, but you don't necessarily get that lower rate.
Okay.
Because
Bait and switch?
Well, no, it's not a bait and
You may
switch.
not qualify.
What happens is that the online industry sells because they can't sell based upon personality. They're going to sell based on rate. So they're all going to compete on rate.
Okay.
They get a lot of people coming in, and if your situation, especially in a divorce situation, gets to be tough, you have something pops up in your credit, you have an issue with the divorce decree. If I have a small margin because my rate's so low, I might just toss you out and take the next person in line because you don't get the rate. If my headquarters is in Michigan, you have no idea. And if you badmouth me, I don't know about it. I don't really care about it. Talk to someone who has to be held accountable.
Sounds like you want a personal relationship, not a pre-existing, but somebody you can talk to in person and figure this out
I think
with.
it's about building relationships, but it's also, when we're talking about post-divorce too, there's a lot of trauma involved, and you need somebody who's going to be patient and not just say, "Stop asking all these questions. I have someone right behind you."
As we said in an earlier interview, we can't even find our tax returns, and it's
That's the
gathering
thing.
all
But I
that
deal with that with
information.
people, and when you say this, there's a lot of other people like that. So it's
Really?
it's for some it's a comfort to find out they're not alone, that there's other people in that situation, and today, luckily, most of the tax returns, I can call up the attorney using a permission form that you give me, the attorney or the accountant, and they can send me over a PDF of your tax return.
Oh, see, that would be so
And
great.
we talked about that with the taxes. I have one last question
Yeah,
because we're going
sure.
to run out of time.
Yeah.
What about taking a 30-year loan versus a 7-year floating rate? How do you know I'm probably using the wrong terminology.
No,
but how do
it's
you
an
know-
adjustable rate mortgage versus a fixed rate mortgage.
God.
Okay.
And that's another good question, and it's going to be, I have a couple of brothers who are attorneys, and their answer is always, "It depends."
It depends.
Yeah.
It depends. So in this situation, I'm not going to just sell you rate. I'm going to say, "Tell me about your plans. How long do you picture being in this house?"
Yeah.
Because if you say, "I'm going to stay in this house till my kids get out of high school," and it's going to be 5 years, why are you going to pay for a 30-year fixed rate mortgage?
Right, because I think you've got to factor in that it's not like you're getting married and buying a home that you plan to live. You may want to move,
But
and
some
you're
people
probably in
say,
flux.
I don't know when I'm going to move. Then get a 30-year fixed.
Okay.
Well, that's why I'm wondering, why don't people, should you just rent? Or are the conditions of the economy right now such that it makes a lot of sense
The rental market right now is heated up, where invariably, if you see a house and you price it out, how much is that going to cost for me to own that house? It's probably, with the tax advantages in there, it's probably cheaper than renting.
Okay.
So we're in a unique part of our economy right now where the rental market is just heated up because there aren't as many people to qualify for a loan because the stated income, no income verification loans are virtually gone. It's a very good opportunity now to buy a house.
Good to know.
All right, well, let's go buy a house, Bob.
I know,
Let's
we
buy
might
a
be
couple.
living together.
How about a
I'll be
vacation home,
talking
too?
to you. All right, Terry, it's so fantastic having you
Thanks
with
for
us
having me
today.
in. I appreciate it.
Thank you. For more information on this topic and others, please visit singleprocess.me.